The call comes at 4:53 a.m. You don't recognize the number. You answer anyway. 18 words. That's all it takes. By 5:01 a.m., you're dressed. By 5:14, you're in a car you didn't call. By 5:30, you're inside a building that doesn't have its name on the door. There are no signs here. No reception desk. No small talk. Just screens, numbers, and the quiet sound of capital moving before the rest of the world wakes up. This is not a bank. This is not a brokerage. This is something else entirely. Most people have heard the word hedge fund. It appears in news headlines, in political speeches, in conversations about inequality and excess. It gets used as shorthand for something vague and powerful, a symbol of wealth that operates somewhere above ordinary finance. But very few people have ever seen inside one. Not because it's illegal, not because it's secret in the way governments keep secrets, but because the people who run these funds have spent decades making sure the wall between their world and yours stays exactly where it is. The hedge fund industry manages roughly $4 trillion in global assets. That number is almost impossible to hold in your mind. It's larger than the GDP of Germany. It moves through currencies, commodities, equities, derivatives, real estate, and instruments that don't even have common names yet. And it moves quietly. Unlike mutual funds or pension funds, hedge funds are not required to disclose their positions to the public. They file minimal paperwork. They operate through structures layered across multiple jurisdictions. A single fund might have its management company in New York, its legal entity in the Cayman Islands, its prime brokerage relationship in London, and its risk systems running on servers in New Jersey. You will never see its name on a building. The people inside do not talk about what they do at dinner parties, not out of arrogance, though sometimes that too, but because the edge they have depends entirely on what other people don't know. Information asymmetry is not a side effect of this world. It is the product. This is a system built on one simple principle. See what others cannot, act before they do, and never explain how. You are about to go inside. Level 1. The Analyst. You start at the bottom. Though in this world, the bottom still pays $150,000 a year. Your title is Research Analyst. Your job, on paper, is to build financial models. In reality, your job is to be wrong less often than everyone else, and to never be the reason the fund loses money. You arrive before the market opens. You leave after it closes. In between, you read. Earnings reports, central bank minutes, supply chain data, satellite imagery of retail parking lots, shipping container counts from ports in Shanghai. You are looking for a signal inside an ocean of noise. The work is not glamorous. It is repetitive, precise, and unforgiving. One decimal point in the wrong place can cascade into a position that costs millions. You learn this not from a manual, but from watching someone ahead of you make that mistake once. You are not managing money yet. You are learning how money thinks. Level 2. The Junior Portfolio Manager. 3 years pass, maybe 4. If you survived, if your models held, if the partners noticed, you get a new title. Junior Portfolio Manager. You now have a sleeve. A small allocation of the fund's capital that you are personally responsible for. It might be $50 million. It might be $200 million. Either way, it is more money than you will ever fully emotionally process. The pressure changes here. Before, you were support. Now, you are accountable. Every morning you walk in knowing exactly how much you made or lost the day before. Not your salary, the fund's money. Your decisions. Your thesis. Your consequence. You start to understand what the analysts beneath you are for. They are your eyes. You are now the one deciding what to do with what they see. The psychological shift is subtle at first, then total. You stop thinking about the work. You start thinking about the position. Level 3. The Senior Portfolio Manager. At this level, the number gets larger. So does the silence around you. You manage a significant book. Perhaps 500 million, perhaps more. You have analysts, a dedicated risk officer, and a direct line to the fund's capital allocation committee. People defer to you in meetings without being asked to. But something else happens here that no one prepares you for. The loneliness. Every major call is ultimately yours. When the thesis is right, the room credits the process. When it's wrong, the room looks at you. Not with anger, with something quieter. Recalibration. You feel the shift before anyone says a word. You learn to live inside uncertainty in the way most humans never have to. You hold positions that could move violently in either direction, sometimes for months, before the market confirms or destroys your thinking. You sleep, but not deeply. You exercise, but it doesn't fully clear your head. You are always, in some corner of your mind, inside the position. Level 4. The Partner. You don't apply to become a partner. You are asked. The conversation is short. The terms are long. You are now part of the fund's ownership structure. You share in the management fees, the performance fees, the upside of what you've collectively built. Your compensation is no longer a salary in any traditional sense. It is a percentage of something that compounds. At this level, you stop thinking about individual trades. You think about the fund's positioning across cycles. You think about the next decade, not the next quarter. You have conversations with sovereign wealth funds, with university endowments, with family offices representing multi-generational wealth. These are your investors. You are not selling to them. You are being evaluated by them. The power here is real, but it arrives quietly. You don't announce it. You don't need to. Level 5. The Founder. This level is not a promotion. It is a rupture. At some point, if you have the track record, the relationships, the risk tolerance, and the specific kind of controlled recklessness this requires, you leave. You raise your own capital. You build your own structure. You put your name, or a deliberately obscure 2-letter abbreviation, on the door of a new fund. Most attempts fail within 3 years. Capital dries up. Performance disappoints. The team fractures. But for the ones who survive, the ones who find their edge and defend it, something crystallizes. They are no longer working inside a system. They have become one. Here is what the levels don't show you. The hedge fund world is not, at its core, about intelligence. There are brilliant people who wash out in 18 months. There are average mathematicians who build billion-dollar funds and hold them for decades. Intelligence is the entry fee. It is not the edge. The edge is structural. Every hedge fund that survives long enough builds what insiders call an information moat. Not illegal insider information, though that line has been tested, prosecuted, and redrawn more than once in this industry's history. But legal, proprietary, painstakingly assembled information infrastructure. alternative data, exclusive research networks, former central bankers on advisory boards, relationships with management teams that take years to cultivate and seconds to leverage. When a top-tier fund takes a position, they are not reacting to the same news you read. They are acting on a conclusion they reached 3 months ago, built from data sources most institutions don't know exist. This is the first hidden layer. The second is the fee structure. The industry standard, though it has compressed under pressure, has historically been 2 and 20. 2% of assets under management per year, regardless of performance. 20% of all profits generated above a benchmark. This means a fund managing $10 billion collects $200 million annually before a single trade is placed. Before a single dollar of return is generated for the investor. The fund makes money when you make money, but the fund also makes money when you don't. This asymmetry is not an accident. It is the architecture. The third hidden layer is the investor side of the equation. Hedge funds do not take money from ordinary people. The SEC requires investors to be qualified, meaning they must have a net worth exceeding $1 million or an annual income above $200,000. In practice, the largest and most exclusive funds set their own minimums far higher. 25 million, 50 million. In some cases, they are closed entirely, no new capital accepted at any price. This is a system that manages wealth for those who already have it. It does not create a new class of wealthy people. It serves an existing one. And in doing so, it quietly widens the distance between that class and everyone else. The capital compounds. The access compounds. The distance compounds. And from the outside, none of it is visible. There is a question worth sitting with before we reach the end. Is this system wrong? Not illegal, not corrupt in the obvious sense, but wrong, in the way that something can be perfectly legal and still reshape the world in ways that were never voted on, never debated, never fully understood by the people most affected by them. The people inside hedge funds are not villains. Most of them are extraordinarily disciplined, genuinely brilliant, and operating entirely within the rules they were given. They did not design the tax code that treats carried interest differently from ordinary income. They did not write the accreditation laws that determine who gets access and who doesn't. They found a system, understood it faster than most, and optimized their lives around it. That is a very human thing to do. But systems have consequences that individuals don't intend. When $4 trillion moves through markets with speed and sophistication that pension funds and retail investors cannot match, the game is not the same game for everyone at the table. When the most talented mathematicians, the sharpest analysts, the most connected relationship builders all flow toward the same industry, drawn by compensation that dwarfs every alternative, something is quietly lost elsewhere. This is the cost that never appears on a fund's performance report. The hedge fund world is a mirror. It reflects back what a society chooses to reward, what it chooses to make scarce, and who it decides deserves access to the machinery of capital. You can look at that mirror and see brilliance. You can look at it and see imbalance. Most honest observers see both at once. The question is not whether the system exists. It does. It will continue to. The question is whether you understand it well enough to know where you stand inside it. It is 4:53 a.m. again. The car moves through empty streets. The city hasn't decided to wake up yet. The buildings are dark, except for a few floors, scattered and high, where the screens are already on, and the numbers are already moving. You think about the analyst who arrived 2 hours ago, still building models, still looking for the signal, still believing that if the work is precise enough, the outcome will follow. You think about the junior manager sitting inside his first real position, feeling the weight of capital in a way that doesn't have a name yet. You think about the founder, somewhere in this city or another, who stopped sleeping through the night years ago and made peace with it. And you think about the investors, the endowments, the sovereign funds, the family offices, the capital that was already large enough to enter this world and will leave it larger still. The car stops. The building has no sign. You already knew that. What you understand now, that you didn't understand before, is that this was never a story about money. Not really. It was a story about access. About who gets to sit inside the room where the decisions are made, and who spends their entire life in a city those decisions quietly shape. The doors open. The screens are on. The market opens in 4 minutes. And somewhere out there, most people are still asleep.